right, everybody, we're gonna get started for our third of the 2023 Lunch and Learn series, tax tips to make your donation go further. This is our third Lunch and Learn for the year. Next month on May 25th, we will do a Lunch and Learn on how to advocate for historic preservation. So that will be on May 25th. And then in June, we will have our Lunch and Learn presentation being on fundraising in the nonprofit sector. So fundraising for organizations or fundraising for causes, those will be covered by our speaker, Dr. Leslie Keys. So if anybody has any other ideas for Lunch and Learn topics, you can put those in the chat. We're thinking through our Lunch and Learn series that will start in the fall. So that will be helpful. But today, as I said, we're talking about how to make nonprofit donations go further with some tax tips. So we're here with Keith Earhart with Moore, Ellison, and McDuffie CPAs. He is going to do the presentation today. And Keith, I didn't know what else. I know you have an introduction slide, so I wasn't going to go into too much more details, except to say you're a wonderful accountant.
Yeah, well, I try. Yeah, I'll go through a few of the little pieces here. I just try to include some things to talk about. Hello, everybody. Welcome to our presentation. Hopefully everyone gets something new out of this while they're spending their valuable time listening. And if there are questions along the way, we will try to address any of them that we can. And if not,
Keith, I forgot to say it's Take Your Daughter to Work Day, and that's why Arabella's here.
There you go.
I forgot to share. That's why we have a visitor for our call. She's learning about
attendees.
yeah, she's learning about nonprofit management and tax best practices. So it's a big day.
All right. Again, we're going to move on. And I'll just do a quick introduction of myself. Again, my name is Patrick Keith Earhart. I go by my middle name, Keith, and I am a partner here at Moore, Ellison, McDuffie CPA firm. I have been practicing public accounting since 2006, back when I was attending FSU. I completed my bachelor's in 2007 with a double major accounting and finance, and then finished my master's of accounting with a focus in taxation in 2008. Passed my CPA exam in 2010 and have been working on taxes throughout my entire career. We do a lot more than just taxation, but that has been one of my primary focuses since I started, and for some reason enjoy taxes. A lot of people avoid them as much as possible, but they're part of our life. So I think it's always valuable to have someone you can talk to and get information from. And I like to be able to help people out in that area where most people are unsure about some of these things. So we'll see what we can enlighten a little bit for today. Going on, hang on just a second, if you'll bear with me. Today, let's definitely start with just some of the simple basics, make sure we're all on the same page as to what we're discussing and talking about. And a lot of time that's definitions about what is occurring. Charitable contributions is the main topic when we're talking about anything here that's being donated and how that is treated on the donor or the donee. The general definition, just that I want to make sure everybody, again, it has a simple, basic understanding, is a charitable contribution is a donation or gift to or for the use of a qualified organization. It's voluntary, it's made without getting or expecting to get anything of equal value. The two underlined pieces on this slide are what we kind of want to focus on to begin with. What is a charitable contribution and what is a qualified organization? These are very important. A lot of people give money to places or different reasons or purposes, and depending on if it's actually a charity is where you're going to be able to get a tax deduction for it. And if it is a qualified organization is also the other major component. So we move on to our next slide here. When you're looking at charitable contributions, and hopefully nothing's in the way here, I'm trying to move some of my pieces around. The Internal Revenue Code section, this is where their definition. So this is basically your legal definition of it. There's a lot of information on here. more than we're going to go into immediately, but I did want to highlight the main pieces of what we're going to focus on today. A charitable contribution defined. For purpose of this section, the term charitable contribution means a contribution or gift to or for the use of, and we're going to be dealing with a corporation, trust, community chest fund, or foundation that is organized or operated exclusively for religious, charitable, scientific, literary, educational purposes, or to foster national or international amateur sports competitions, but only if no part of its activities involved the provision of athletic facilities or equipment, or for the prevention of cruelty to children or animals. So the biggest thing that we're going to be hitting on is, of course, charitable organizations today. These are generally, by this definition, going to be corporations or foundations. You can have other legal entities that fall into this particular category, and that entity must be organized or operated exclusively for the main components that we typically see: religious, charitable, scientific, literary, or educational purposes. And that the rest of these are other areas that a charitable deduction could fall into. Again, we're not really going to focus on these today. The second page that goes into this is also more of the same code section. As you can see, there are a lot of aspects in general when you're dealing with a charitable contribution, and it encompasses a lot of areas. But we are not going to hit on all of them today. When we next look at our qualified organizations, that's the second component that's very important that we think about. All qualified organizations are nonprofits, but not all nonprofits are qualified organizations. This just means that in the world of taxes, you can have nonprofits that are tax-exempt organizations, but that does not mean that they are a charitable organization. And again, we're not going to go into all of these different kinds. Just want to bring a big focus that just because you're giving money to a tax-exempt organization does not mean that it is going to be allowed for a charitable deduction. Qualified organizations are most commonly exempt organizations eligible to receive tax-deductible charitable contributions, which include most charities described in Section 501c3 of the Internal Revenue Code. Again, on our previous slide, we were looking at Internal Revenue Code Section 170. That's essentially defining your charitable contribution. 501c3 tells you what type of organizations are allowed, and those are specific to charities. There are other organizations that can accept them, such as ones listed here: fraternal organizations, cemetery companies, volunteer fire departments, veterans organizations, and other entities that are exclusively for public purposes to a state or political subdivision. We're not going into these. We're focusing on the 501c3 aspects today. But again, that's just a part of the entire section and complexity that all of these things can go into. Again, when we're looking at qualified organizations and you're thinking about who you're going to be giving your money to, you must verify that these contributions to your organization will be tax deductible and what activities those contributions are for. You're always welcome to give your money to any form of nonprofit organization. They all will need that money. Those funds help for very good purposes. But when you're looking for a tax deduction for that contribution, as far as a charitable contribution, you got to make sure you're giving it to the correct organizations. You can do a little bit of research that you should look on. The IRS has the website listed there for exempt organization search, where you can put in the name or the EIN of your organization that you're looking for, sometimes the address or other specifics, and actually pull up and see that the IRS has them listed as a tax deductible charity that you can contribute to. Other organizations may come up as well, but that's what you're going to be looking for when you do. You can also go out to GuideStar, is a good website that you generally have to get a login credential for yourself. It's free, but you can then pull information on all different organizations, most especially their historical filings of Form 990s, which are required for nonprofit organizations. They will tell you in that 990 that they're a 501c3 organization, and they're also going to give you a lot of great information to research what the organization does. You can always go to the website of the organizations and hopefully everything is accurate that's out there, but people can believe that they are doing the right things and may not have done everything quite correctly. So those are two good websites to look at to get a little more information and be able to secure that you're giving to a good organization and that they qualify for the deductions that you may want to take on your personal or corporate return if that's what you were filing. Again, I do say review the Form 990. You can get a lot of great information about what expenses they are, where their revenues are derived from. There should be listings of activities that they've handled. There's a lot of information that gets in there. And if you haven't looked at one before, it can be a complicated thing to read through, but I think it's very important if you're going to be giving large sums of money to organizations. If you're making just general donations, you may not want to do as much detailed research because you just like the principle behind what they are. But if you are regularly contributing, it's nice to see where those contributions are going. Whenever you give a charitable contribution, the organization is required to give you substantiation of that contribution in many, depending on the amount, but you should always have a substantiation for your part, for your records, when you're taking that tax deduction. There are a lot of different pieces that you have to look at as far as value, what was donated. We're going to cover a couple of the categories that I think are just a high level that you need to consider when you're giving money. If you're giving less than $250 at a time to an organization, one of the main things you're going to want to get is your banking record. You can also get a written communication, but not all organizations are going to give them. If they're on top of their game, they should, no matter what the amount is, because it's an important contact and personal touch and a thank you for any organization, but they may not or may have slipped through. So to protect yourself, make sure you have some kind of a statement from a financial institution if you were to have transferred money from, say, an investment account or something else that might have their name listed on there so you can prove that it went to a charitable organization. If they provide some kind of electronic fund transfer receipt, if you went online and made a payment, they should give you an acknowledgement of that payment. That would suffice. Certainly a canceled check if you wrote it from your bank account going online and get a copy of it, or the physical check if you have that in there, you can make a copy of it. Or credit card statements, when you make them there, sometimes they list the organization. Any of these are just examples that you can utilize. Again, when you have less than $250, it's not as important, but you should always have the record in your hand, not necessarily the written communication. As we move on to the next side, as far as substantiation goes, when you are greater than 250 but less than a $5,000 threshold, it's what they call contemporaneous written acknowledgement, which is essentially your acknowledgement letter coming from the organization stating that at this date or within this year, the tax year, they did receive a donation from you. Generally, that amount is going to be listed, so that substantiates what you're going to be putting on your return. And of course, if you're an organization, you certainly want to send these acknowledgement letters out for any donor that is provided to you. Again, even when they're below 250, that letter may not be required, but it is something that is, again, saying thank you for someone thinking about you and providing funds to operate your organization. This letter in general, these letters can have a lot more that is required, but the basic things that need to be in here is that you need the amount of the cash and a description, but not always the value of the property other than cash that's contributed. That's because sometimes property, you don't always know what that value is that was given, and that's why it's stating there that it may not be required, but at least tell what it was that you received. You also have to state whether or not the donee organization provided any goods or services in consideration, in whole or part, for the contribution. If there is something received for the contribution, it's not going to make it no longer tax deductible, but it will reduce how much that deduction could be, such that if you went to an auction and at a charitable auction, you purchased something and ended up winning, you put into it, you ended up winning that prize, but of course you probably paid more than it was worth. the value of what it's worth is going to reduce what you actually paid in because you receive something. Generally, most contributions are just made out of the goodness of somebody's heart. They want to help the organization, so there is nothing received, so the full amount should be deductible. You would also need a description and good faith estimate of the value of the goods and services if those were provided, or if the goods or services consist entirely of intangible religious benefits, then a statement to that effect. Again, and that would be something for a religious format or organization, churches that are getting donations. And of course, there is the feel-good piece of it. Any of these letters, the documentation, the substantiation, these written letters, must be received prior to filing your tax return. So as the donor, you want to make sure you get this letter before you file, or if you have an extension of the return, you also have till that timeline, but it needs to be dated. If you do not have that letter and the IRS were to come in and ask you about substantiating the deductions that you took, they can most likely will disallow it if you don't have that letter. So again, organizations providing these letters is beneficial in multiple fronts for the donors, and the donors having these letters as receipts is extremely important to make sure that they do get their deduction. Most charitable giving is definitely not for the tax deduction purpose, but it is very nice to be able to have that deduction for having helped out these organizations. I don't go into it, but listed on there is the $5,000 number. Monies or contributions that are over $5,000 that are not in cash, that's usually some form of property, have a lot of other requirements that you must get into as far as reporting on personal tax returns or providing to the organization, such as they generally will need an appraisal and substantiation of that value. You cannot just come in and say, oh, this thing's worth $6,000. Here you go. I'm going to get a tax deduction and everything's good to go. So just be aware, I'm not really covering that aspect here, but when you get into the larger dollar values, you do want to make sure that you have gone over all the additional requirements involved. When you're giving deductions, there are a lot of considerations you need to have. The first is, as far as a tax deduction for an individual, to be able to utilize that deduction, you must be able to itemize on your personal tax return. And there are different limits that you must be aware of when you are trying to itemize, such as for 2023, if you are a single individual, your itemized deductions must exceed $13,850 in order to be able to itemize. There are charitable contributions, or one of the items that are in an itemized deduction. There are also taxes, there's mortgage interest, there can be medical deductions and a few other categories that you could add into that. But if you're not exceeding this number, then just expect that you're not going to get a direct tax benefit. If you are exceeding these numbers, then you'll want to make sure you have all that documentation available. And again, if you're just helping out organizations and providing funds for them, that's great. But if you're planning for a tax deduction and how to maximize that, you'll want to be considering these levels, especially if you're a married filing joint. $27,700 is a large amount to have to get over. If you're head of household, which is the HOH, that is for a single individual that has dependents. So each of them has different levels that you must be thinking about. If you do have amounts that are over your itemized deductions, there are still limits that you can run into based on your adjusted gross income. And that is essentially your total income that you have, minus a few adjustments that are allowed on your personal income tax return before you get to your itemized deductions or standard deduction. Along the bottom, there are several categories that are kind of tiered, if you will, when you are trying to calculate this. The first being there's a 60% of AGI limit. And these are for cash contributions to a 50% charity. You'll hear that term. 50% charity is just kind of another term for generally a 501c3 charitable organization that's allowed to accept tax deductible contributions. The 60% limit means that they're going to look at what your AGI is for the year. And they're going to say, okay, if your AGI was $100,000, then 60% maximum, which would be 60,000, can be in charitable contributions. That's the most you could take in 1 year. So if you happen to have 100,000 AGI and decided, you know, I'm going to give all of my money for the year to a charitable organization, well, you're only going to get to deduct up to 60% in the current year. So again, just a consideration when you're planning for how much you're going to be contributing. You need to also think about what your income level are for that year, because you could get very limited when you're expecting to get a full deduction. The 60% limit again is covering just for cash. Generally, there was always a 50% limit, which is the next category over for total deductions. That is your general overall limit. Is 50% of AGI is the most that you're going to be able to deduct in the current year. Now, depending on the type of property that you provide and that you contribute, you can get into some of these other categories, such as the 30% AGI limit. These are to non-50% charities. So some of the other organizations may have a reduced AGI limit, that while they are allowed to accept the charitable contribution and you're allowed to take a tax deductible contribution, the amount you can deduct in 1 year is reduced. Also, there's another 30%, a second 30% AGI limitation for gifts of capital gain property. And we're going to talk more about this in the next few slides. But this is if you gave, instead of cash, you gave assets to some organization that hopefully will utilize those assets. And they're considered a capital asset to the donor and being given to the donee, the organization. These are assets generally that you have held for more than a year. Again, they're usually tangible or physical or some other type of property that is being given to the organization to utilize. And because they have this capital gain aspect, which is a preferred tax treatment for an individual if they were to sell it, you are now donating it. It is limited to this 30%. And that's usually because these types of property have appreciated in value from the time at which you purchased it. And if you were to sell it, you would have capital gains on that particular asset. Now, you are allowed, whenever you have gain, just so people make sure they understand, you have a fair market value, you have what you originally paid for it, and then the difference between those two, what you sell it for to what you originally paid, would be a gain. What you originally paid is your basis in that particular asset. With this 30% category, you can elect to just take your basis as a donation as opposed to the fair market value. And then you can go back to the 50% deduction like any other property would have been. If it is substantially appreciated, you certainly would not want to go that route. However, if you were donating something worth $50,000 and maybe your original cost in it was only $45,000 and you need a higher deduction this particular year, you can elect to take the $45,000 instead of the $50,000 number that was the market. So there's times where it's not going to really penalize you too much. Again, that depends on your circumstance for that particular year. You just need to be aware that these limits and options are out there. There's also a 20% limit. Again, that's giving this capital gain property to a non-50% charity. You have an even lower threshold that you're allowed to take per year. So again, I would mostly consider, if you're trying to get the most bang for your buck in a contribution, is giving to the 50% charity, because the other limits are out. And then you're going to have to evaluate what you want to do depending on the type of property that you're giving. So those are the main deduction limitations you want to be considering when you're giving charitable contributions and wanting to take a tax deduction. When you are limited in a particular year, thankfully, that limitation is not lost, that deduction. So if you don't have enough income in 1 year, or you have some of the lower thresholds that you can't deduct everything, you are allowed a carryover of that charitable contribution to future years. That carryover will be allowed for 5 years that you can utilize it in. So if any of the following years you are not giving contributions, you're allowed again to look and see, you know, can you itemize? And then is your AGI enough to utilize some of that? So again, it is not lost immediately. When you are calculating the future year contributions and what your tax deduction is, you must consider that any of the current year contributions are used first. Again, that's going to use up that 60%, 50%, or 30% AGI limitation. And then any of the carryovers are going to be utilized that year. So again, planning in future years is very important that you're not going to lose some of these. If in a following year, you don't have enough to itemize, so theoretically you're not using your charitable contribution because you're just using what's called the standard deduction for that year, you still have to reduce the carryover. So you can lose some if you're not itemizing in future years. So again, when thinking about trying to maximize those deductions, be careful that you are considering how much you can utilize in the 1 year and what that's going to look like in future years. Going over now into some of our charitable planning, that's really probably more of the highlight. Now that we've kind of covered, what you must give, how you can give, who you can give it to, and then looking at your ultimate deduction. What are our options for being able to provide that, as far as just simply giving money? And then when we do, what can we do with it? How do we do it? What are those best practices? And these are where I'm going to try to spend a little more time. These are going to be high-level discussions on some of these. But if you have further questions, we can always try to dig into it more, or you can ask or do a little bit of research on your own. One of the first things to consider is to alternate bunching of contributions. So if you just typically like to write out checks to charities, one or multiple in a year, you can do them once every year. Maybe every December you like to sit down and think about who do you want to help, what organizations are important. But if you do that, again, you must get over that itemized deduction threshold that we were talking about, or what the standard deduction is. And in order to exceed the amount that we were talking about on those previous slides, you might want to give 2 donations in 1 year. And that's what this bunching is. So maybe in January and then December of the same year, you write out your donation. So if you do $10,000 of donations typically every year, turn around and do 10 in January and 10 in December. And that way, even though you're delaying a month for some of them, you're going to double up and you'd have 20,000 of deductions, charitable contributions in 1 year to take. That might be enough to put you over that itemized threshold, along with other things like mortgage interest, real estate taxes, or medical deductions, and you'll exceed that standard deduction amount. The following year, you'll just take the standard deduction that's already allowed based on your filing status and not do any charitable contributions, and then turn right back around. And that following January, again, start doing your contributions for that year doubled up. And that's really what the bunching is. You're just trying to 1 year exceed the itemized deduction threshold, and then the following year just plan on taking the standard, but at the same time not trying to give any less. It's just timing what you're giving during the different periods. That's very simple way to maximize those in a period without not giving in 1 year. Really, you're just moving it around and delaying from a December of every year to a January and a December, and then you wouldn't for the following. The other aspect that you'd want to consider when you're donating is, like we were talking about the capital gain assets, is donating assets that have appreciated in value. Again, this is when you purchase the asset at one amount or value, you've held on to it for more than a year, could have been 5, 10, could have been 50 years, whatever it may be. You've held on to that asset and it is appreciated, and now you're trying to decide, what do I do with it? You can sell it, certainly. And what's going to happen when you sell it is you're going to have to realize taxable gain on that appreciation. Again, the difference between the market value at which you sell it and the basis at which you originally purchased it or had ownership of that. And you're going to lose on the actual cash available for the gain in tax that you have to pay. However, if you turn around and donate that asset to a charitable organization, you don't have to realize any of the taxable gain on it. This provides a deduction and removes, like I said, the taxation immediately. That the organization can then take that asset and utilize it for their purposes. And there are some additional requirements that can come up there. But generally speaking, you're going to get a fair market value of that asset at the contribution and not have to take the taxable gain. Now, you will be limited on the percentages we talked about earlier, but this is a win-win for both sides, honestly. Again, when you contribute that asset, it must be a capital asset held for more than 1 year. If it's an ordinary income asset, such as something in your business that you were contributing, or you haven't held it for a year, you're going to be limited to just the basis and the asset. So you certainly want to have held this property for more than 1 year to qualify. If you're giving tangible personal property, it must be related to the exempt function of the organization. So you cannot just say, I want to give you some of my old stuff and try to take a tax deduction for it. It must be useful to the organization, something that they're going to want. If they sell within 3 years, you could have a reduction or recapture of deduction. So you must be careful about what it is donating and how it's going to be used in that organization. And depending on the value, like we talked about earlier, especially things over the 5,000, they may require an appraisal to substantiate the value. You can't always just say, well, I think it's worth this, and the organization wants to accept it worth this. You may need to get an actual qualified expert to tell you what that value is that substantiates the deduction that you will be taking. Going on to another aspect of planning, you could do something with what's called a bargain sale. Now, this is where when you have one of those capital assets you're going to contribute, maybe you still need some funds from it. You don't want to give up 100% of it. It has value, or there's some other purpose that you need, but you also want to help out the organization with this asset. So you can do what's called a bargain sale. And you are providing a gift to the organization and some cash for that. So the organization may give that cash flow to you, but of course the cash that's coming out is much less than the value of the actual asset. That is where you're selling it essentially for less than it. That's why it's called a bargain. Your donation that you can take as far as the tax deduction would of course be the fair market value of that asset, less whatever proceeds that you did receive. But again, in this way, you are giving up the asset. You're going to reduce the taxable gain that you're going to receive on that particular asset, and the organization is going to get the asset to utilize there. So it's a little bit of a win for both sides, a little extra complexity than just completely giving it, because of course then you are going to have a taxable amount, and you can't take 100% of your basis to apply against what you sold. You must prorate some of that basis based on the market value and sales price to the assets sold. So you will have some taxable gain that's recognized on it. But again, there may be a reason that you need some of that cash flow. So this kind of helps both sides. If you have hit retirement age, you have been exposed to, and you have IRAs or certain retirement accounts that have required minimum distributions. These are calculations that are done based upon the value of your retirement account, the age of the individual that's taking them. They are adjusted annually for both circumstances. You'll find out the year before what your minimum distribution will be for the following year. And people have to take out money from their retirement accounts. Well, when they take out these monies, that's generally taxable to the individual because it's gone in pre-tax. If you go and do what's called a qualified charitable distribution, this is where you're going to get whoever is maintaining your retirement account to make a distribution directly to a charitable organization. You do not want to take the money out of the IRA and then turn around and make a contribution yourself. You really want to follow the correct steps, talk with whoever is administrating your plan. They will help you with this. But they make the donation, they transfer the money directly from the retirement account to the organization. And what this does is it can satisfy your required minimum distribution. So if you had an RMD that was $5,000 for the year and you said, you know what, I don't need any of that money personally, I have enough funds to live off of, you turn around to your retirement plan and ask them, the administrator, to take that $5,000 and distribute it directly to one of the qualified charities of your choosing, and they will make that distribution. What this does is you are no longer allowed a tax deduction for that $5,000. So you are not going to get the deduction. However, you also aren't going to have to pick up the income from that distribution. And that has a multitude of benefits. If you're not able to itemize in a particular year, well, the $5,000 tax distribution or tax deduction doesn't help. It's not going to make a difference on your taxes. However, not picking up $5,000 of income certainly is. So this is a great way to reduce taxable income. And your AGI is also going to be a calculation that occurs for a lot of people in things such as Social Security and Medicare. By not increasing your taxable income, you can actually reduce what taxes are going to be taken out on that income or your health benefits and other areas within your individual tax return that are affected by that overall AGI or total income number. By doing these qualified charitable distributions, you are reducing that impact, which is a great benefit to individuals. You want to make sure, of course, that you don't donate more than $100,000 in a year under this particular method, because that is going to be the limitation. And again, like I talked about, and we'll stress, make sure that it's a direct transfer by the trustee to the charity. You do not want to do this on your own, because otherwise you're going to pick up the taxable income when the distribution is made to you. And then if you itemize, then you can take a tax deduction. But if you don't, then all you've done is pick up your income, unfortunately. So it's a great way to be thinking about passing on funds that would not have to have a tax impact and still helping out a charity in the process. There are also other options that if you had a retirement account, and again, if you're well off and you're trying to figure out what to do, you could designate your charity as a beneficiary of your entire retirement account. You might have multiple accounts, so you may choose a small one that you don't want to draw off of. Again, every retirement account should have a beneficiary assigned. Please make sure that's done. But in the process, when you're trying to think about what's going to happen with that account after you pass away, it becomes very important, and you can designate a charity as the beneficiary to take over those investments and utilize them for their purposes. That removes taxable income from your estate or any of the other beneficiaries that might have been passed on to. Again, if you're wealthy and your whole family's doing really well, you may not need the retirement that you put away. So it's a wonderful way to benefit very needy organizations. If you did not want to give away all of your retirement account and said, well, you know, when I pass away, I'd like some of it. You can do percentages as beneficiaries if you wanted to set up. You can also split that retirement account into separate ones and maybe make the charity 100% beneficiary of one and other family members beneficiary of the other. So there's just options there. There's planning that you can do with this after you've passed away and you want to make sure these particular funds are handled and sent to the right places and people to help out. As another option, you could set up what's called a qualified terminal interest property trust, or a QTIP trust. This is generally set up between spouses, in which married individuals set up a trust essentially for the secondary spouse that is going to survive after the first passes away, with ultimately a charity to receive the remaining benefit after that secondary spouse's death. This provides some control to the grantor, which is the person that sets up the trust, how they want those funds to be utilized for the secondary spouse to live, and then ultimately where those funds go afterwards, which is to the charitable organization of designation. And we're not going to go into estate tax whatsoever right now, really, but when you pass assets on to a married spouse, they are shielded from any estate taxes that are going to occur. So again, this is looking forward by providing your estate to your loved one. And then once their time has ended, you are going to pass on that earnings and appreciation to an organization to continue to benefit the world. Another option you can look at is contributing to a pooled income fund. This is similar to like giving money to a mutual fund if you thought of it, but ultimately the end owner will be a charity. When you give to a pooled income fund, you will get a deduction in the current year of funding, but it's not going to be 100% of whatever you fund it with. There are calculations that go into the value, the life expectancy, other aspects that will determine what you can take as a tax deduction, and it is not 100% of what you put into this fund. But when you're doing a pooled income fund, usually, again, it's a pool, just as the name says, that your gift is going to be merged with gifts from other donors into this overall fund. Your portion of allocable earnings are going to be distributed. It could be quarterly or annually, depending on how it's set up. And that's going to be taxable income to you. So it's much like having an investment that you put money into, and you're going to get some of those earnings back. Of course, those earnings aren't guaranteed. That depends on the market, and everybody has seen how that can go over the last couple of years. Sometimes great and sometimes very bad. But again, it's an investment, and the earnings that you get back are going to depend on how that investment's managed. Charity will receive the remaining balance after the death of the donor. So once you put the money into the fund, essentially you're going to have given up your rights to it other than the income that's generated over the years. Once you pass on, then the charity will get the remainder of that, and hopefully it has appreciated, so that's a benefit, an income benefit to you during your life, and an end benefit to the charity once you have passed away. Similar to a pooled income fund is a donor advised fund. Again, you're making an investment into a fund that can have asset or investments held in it. You can make one large contribution to a donor advised fund, multiple contributions, but once you set it up, you can also put cash or appreciated assets. So maybe you own stocks of your own that you want to put into this fund now, that are going to generate income and increase in value, but you fund this donor advised funds. You get a current year deduction for the full amount contributed. So that's a little different than the pooled income fund, where you have to do a different calculation as far as what your tax deductible amount is. You are allowed to control these funds, but you're not going to get earnings off of them. So that's the difference. Once you put this asset or assets, cash into this fund that's now going to invest and make earnings, those are not going to come back to you. They are going to stay there for the benefit and distributed for charities. Sometimes you have to make a large initial contribution, so you do have to look at what the requirements of that donor advised funds are and who's going to be handling it. But then going forward, what's nice is annually or quarterly or however often you like, you can choose different charities you want that money to go to. So basically you're building an investment account, and as it grows every year, you give out funds just like you would of yourself, but you're no longer going to get a deduction in the future years when you're giving that money out, because you got the deduction up front when you contributed. But it does also allow, you can get family members involved and other people that want to be a part of giving and learning how to make decisions to help all these organizations. One of the last things we're going to cover here, these get a little bit more complex, so we're just going to touch on them a little bit, is a charitable remainder trust. And you can have what's called a unitrust or an annuity trust. Essentially, both of these are trusts that you set up. The main difference is that the remainder, or the unitrust, has a percentage rate of return. So you're going to put assets into this trust, and as these assets generate income, that annual income is passed back to the donor at whatever percentage rate you set. So maybe you said 5% of whatever this earns in the trust, I want it to come back to me, and you're going to get paid out. That's also going to be a taxable event every year that goes on. But when you contribute to this trust initially, you're going to get a deduction the year of funding, but much like the pooled income, there it's going to be less than 100% of whatever you contribute for the year. Because again, it's going to stay in this trust for a while. It's not going to the organization immediately, and you're going to get earnings off of it, but hopefully that investment continues to grow. At the end of the trust term, the charity will be the beneficiary and get the remainder of the assets. So again, this is setting up something for an immediate deduction that is going to hopefully grow and be passed on, but you're going to have income for the period of your life, and then we'll end on, or the period of the trust, depending on which is longer. And then ultimately the charity will hopefully get a benefit when it's all over. The difference between the unit trust and the annuity trust is, again, with that unit trust, you're setting a percentage that you're going to get back, which is valued every year on the overall value of the investment. The annuity trust, you would set up saying, I want a certain amount. And of course, if the investments have not earned enough to pay you that amount, it may have to sell investments, it could dwindle. So there are a lot of considerations to go into when you're setting up one of these trusts, and they can be somewhat complex, but a great vehicle to get exactly what you want done with your assets, and as far as helping control where those assets end up afterwards. There's also what's called a charitable lead trust, which can be a uni trust or an annuity trust. I didn't go into them here because they're basically the same thing, except that the earnings annually are not going to the donor, they would be going to the charity. So every year for the term of that trust, the charity would get a donation or get an amount distributed to them. The donations is when your tax deduction when you funded the trust. And then annually after that, for the term of the trust, the charity would get a payment. And then ultimately when that trust ends, those funds would go maybe to another family member. So it's kind of a flip depending on which one you want. If you wanted the income going to family members up front and then charity get it in the end, or do you want the charity to get them up front annually for a certain period, and then the family member ultimately ending up with everything after? Those are major discussions that you should have with any financial planner. Make sure that what your intentions are with your assets, what funds you want to help out, what charities you want to help out, how to best utilize those assets for the period in which they're going to be out there and ultimately end up with. That is the end of the presentation I have for today as far as talking about different tax tips and options with your charitable contributions from the donor or the donee. I hope that everybody's gotten something out of here that either answered questions you have, or maybe has raised some questions you want to look into further. I would be glad to help out for anybody where I can, and or talk to the organizations or the other investment providers that you have already been working with, and they can provide you some more detail with some of the options that are out there, more so than just giving. And after that, I'm going to turn it back over to Melissa to wrap this up.
Thank you, Keith. I appreciate that. This has been very, very helpful. I did have kind of a quick question for you. A lot of the folks that we share our Lunch and Learn series with is our professional members of the Florida Trust. So there are a lot of nonprofits that are included in that. So I feel like a lot of the people who will be watching this will be coming from that nonprofit lens. So I think you've provided a lot of really helpful information for nonprofits. I guess my question for you is, I know a lot of us as nonprofits would love to be included in that charitable planning piece. What is the best practice for engaging with potential donors on that? Is it to connect with financial advisors? Is it just to, through the 990s, like you talked about, the importance of having strong and accurate 990s? Is it working with individual donors? What would be the best thing for a nonprofit?
There's a lot of different ways, and none of them are exactly right. Getting your message out to what your organization's doing, and that's such as through the 990, through your websites, through networking, getting people to understand where those benefits are really coming from and why they should contribute their hard-earned money and their wealth to those particular purposes, and connecting with them is just such an extremely important part and a difficult part. I mean, it's essentially boiling down to almost advertising, but that's obviously not what you're doing with a nonprofit, but it's the same kind of circumstances. You want to get that recognition. Contacts with, yes, any form of investment advisor. CPA firms deal a lot with clientele. They talk to people about what they want to, and getting in touch with any kind of professional advisors that you can get your message to, that hopefully they will then echo that message back out to individuals, and just networking along the way. It's extremely important to get people to be aware of your organization and any of those methods that you can learn about. And I'm sure I would always be attentive to learn, because I get the same question from other nonprofits, is how do we get that message out?
Mhm.
And that's just talking with people in general.
Okay. All right. And then my other question, I thought you gave a really good tip about the importance of thanking, but acknowledging donations. I think that's a really good takeaway for nonprofits. And I think you mentioned that it needs to have in the language of the thank you that no goods or services were received. Is that
Yes,
something
we're
that should
provided
be?
for it. That
Okay.
is a very important aspect of it. You know, most of these letters will say that you are an Internal Revenue Code 501c3 charity, so it's a tax deductible contribution. There's other things that you can add into it, not always required. You know, certainly having your logo, message of how that contribution helps, if there's something specific for that year that was accomplished, or what you're going to in the future year, and of course your general mission for that nonprofit is always great to put in there. Some of them are just as simple as, thank you for your donation of $100 and no goods or services were provided. We are a charity. Here's our EIN and address. I've seen all different versions, but that is extremely important. And even for, you know, the $25 one, yes, it's kind of a pain for someone that sends that to keep track of all of those, but that makes them remember. And the person that's maybe sending the $25 or the $50 to you could have a lot of money or no family that, like I said, with a lot of that estate planning, turns around and ends up being an extreme benefactor. Maybe they gave out to hundreds of organizations, so they gave out little amounts all over, never a large amount to one, but you might be the one organization that touches them. And those thank yous have a massive impact. And so you want to make sure that you can get that appreciation from them, because they've done a good deed.
Yeah. Good news. Daphne is printing out all of our thank you process, and we're going to have a little package for you to review to make sure we're doing a good job with that. Because I think with online giving, you know, it is a process. You get that immediate response, like we received your donation, and then we have follow up. So
Yes.
Is there any other questions that we've received, had sent in, or that participants want to share at this point?
Yes, I have a few queued up. If you're ready to take them, Keith. And again, thank you so much for your very informative presentation.
Go ahead. I'll try to answer what I can here.
All right. So I'm going to also post them in the chat so that people can read them. But let's start with another disclosure question. So the question says, I've heard that some states require additional disclosure statements for gifts, and that is, I think, for non-cash gifts. Does Florida require any other disclosure or documentation?
None that I know of specifically. Florida being a state that there's not an income tax in for individuals, you don't really have to substantiate anything for state purposes. If you were a corporation that was donating to charities, then you would still, much like an individual, because that's a tax-paying entity in itself. But Florida's general requirements are in line with what the IRS is, as far as what that acknowledgement letter needs to have, as far as I know.
That makes sense. Thank you. The next question that we received is, if the gift is made through a donor-advised fund, should the charity provide a tax receipt to the donor, or does the donor-advised fund do that?
The donor-advised fund usually will not, because they're not the one acknowledging the gift. They may give you a receipt or a transfer piece that has said, you know, this much has gone to this place. But I would always recommend, again, like we were talking about with the letters, sending it out. Don't send it to the fund. send it to the donor just to let them know, thank you for it. But I would remove the language in there about being tax deductible or getting a deduction for it, because that donor got a deduction up front when they gave to the fund. As they distribute money out on an annual basis to the different charities or charity, whatever it may be, they're not going to get a tax deduction anymore for it. So that piece is not applicable. However, sending out the acknowledgement letters again saying, hey, we appreciate you remembering us, and I hope that you continue to remember us.
Thank you. That's very useful information. All right. The next question is, how do I determine the fair market value of my gift?
Well, that can get into a whole slew of answers there. Obviously, cash is going to be worth cash. So that's generally, when you're speaking, is some other type of asset other than cash that has been contributed. You would have to look at if the organization took it and then turned around and sold it quickly in basically what's called an arm's length transaction, then that would be the value. That would be a representation of what your market value would be. If you were able to look at comparable sales of a similar item, you could utilize that for helping determine what fair market value would be. And whenever we say these, just because you determine that ultimately doesn't mean that if the IRS looked at that value, they would agree. So any of these things, again, when we were talking about the substantiation, is you would want as much evidence and support for what that value is. You also may be able to find a replacement cost of that particular type of asset may indicate what it is. So you're not selling it. You may not have comparable sales, but somewhere out there is a way to figure out what the replacement would be. You would also get appraisals, which are generally what we recommend for most any large item that is donated, is that you're getting a third-party valuation done that you can lean on and show that this individual that was qualified to appraise it, which is very important, has put that value on there. And that way the organization has what they need, as well as the individual that's donating it, and they have the substantiation that they're not trying to be fraudulent in whatever that number is, that they're relying on some other expert opinion and the support that expert has derived to get to that value.
Okay, yes, that's very, very useful to know, both for the organization and the donor.
Yeah.
All right.
I think we have time for one more, Daphne. I want to be mindful of our 1 hour. If you have one more, or anybody else has one, they could share it.
All right. Let me see. I got one. So the last one is it preferable to donate stocks or real estate directly to a charity, or sell them and then donate the cash?
So again, the answer that's always correct is it depends. But in general, I would say that you would want to donate the asset directly to the charity. And this is going back to our discussion earlier of capital assets. If you sell the asset and there's a gain, you're going to get the cash from the sale, but you got to pay tax on it. And if you're in the highest tax bracket, that could be 37% on that asset, could be more. Depending, that you're not going to have that cash to turn around and give to the organization to get your deduction. However, if you give the appreciated asset directly to it, and of course you have the valuation on what that value was, then you get the full deduction now without having to recognize a tax on the difference. So anytime you have an appreciated asset, I would say donate the asset. If you happen to have an asset that has lost value for some reason, I would say go ahead and sell that asset, take the loss if it's allowed for your personal return, and then turn around and put that money, which is what you would have gotten as a donation for the fair market value anyway, to the organization at hand. Hopefully that clarifies that.
Yeah, I believe it does. Wonderful. Thank you. And thank you again for sharing your expertise with us today.
Yeah. Glad to be a part of it. Hope everybody got something out of it.
Thank you. And we will share it with all of our members who couldn't make it today. So it's just going to go on and on, Keith.
No, good.
All right, well,
Well,
thank you.
I enjoyed it very much. I hope you all have a good day.
You too. See you soon. Bye.